Welcome to Action Energy Market Global podcast. My name is Tarja Teppo. I'm the founder of Action Energy Finance. In this video podcast, we interview people that work with clean transition. We highlight solutions and stories behind them and explore project financing options utilized. Okay, and today we got to Action Energy Market Global. We have Aleksi Lumijärvi from Ardian eNordic. I know that I may be sort of pronouncing this in the wrong way, but eNordic, is this correct, Aleksi? That this is eNordic is sort of the Nordic arm of Ardian. Is that correct?
Yes, an operating partner in the Nordic countries and Baltic states in the energy sector investments. Yes.
Okay, very good. But hey, let's start. Say that again.
eNordic.
eNordic. Okay, now we got it all sort of correctly. Okay, but Aleksi, why don't we start with your sort of about your personal path? With eNordic, you are the director of investments and M&A, and I guess you've been there for some years, but we've known each other for some time. So I know that you've had a sort of a long path in the sustainability and energy sector. So if you sort of open that a bit, how did you get involved with energy and sustainability issues in the first place?
Yeah, thank you. And first of all, thanks for inviting me. But yeah, how did I get into this business? So that is a long story. I like long stories, but I try to keep it short. But it all started in the university actually already. So I was planning to become something totally different, and let's talk about that maybe later in the next podcast. But in any case, somewhere like mid-air, my studies, I figured out that this is what I'm interested in. So I'm quite proud. I've been in this business starting from the beginning of the millennium, so like 25 years, quarter of a century. And I figured out already late 90s in university what I want to do. And here I am still working in this field, and I'm pretty interested, pretty motivated. I really like the space of the energy transition, and I have a business education. It's been always about energy transition, especially investments and financing, but also more broadly about markets and regulation. So I started my career as an energy sector consultant in a company which is nowadays known as AFRY, the global engineering consulting company. So they're in their energy business group as a management consultant, working truly globally in this field. Like it's difficult to imagine many countries where I would not have worked on some kind of project. Thereafter I've been working in different another consulting company. I've been in financial advisory. I've been working in investments on the investment side from different perspectives, like now. But I've also worked several years in international organizations and international financing institutions, like multilateral, multinational type of institutions, and which I think is also quite interesting.
Yeah, you see it sort of from
these things. So,
different side of the table.
Exactly. So how I would summarize it, it's always been about energy transition and mostly about things related to investment finance markets, but from quite many different perspectives. And when it comes to finance, which I think we're going to talk about today, so they're also quite broadly from venture capital to infrastructure and anything in between. So, yeah,
right.
That's in short.
Okay, super. So that actually sort of creates a nice bridge to what Ardian does. And let's start with, you said that eNordic is part of Ardian. So what does the big Ardian do? And is it a French company, or is it?
It is. And strictly speaking, I didn't say that it's part of Ardian, but it's Ardian's operating partner. So there's a difference. So we are actually, eNordic is an independent firm domiciled in Finland, and we have an agreement with Ardian. So Ardian has this concept of operating partners by which it establishes like exclusive cooperation between certain Ardian's funds in certain sector, in certain geography. And by this way, Ardian taps to sort of local, regional, sectoral knowledge, people on the ground who know the market and the networks and regulations, etc., which is pretty important when you invest in things like infrastructure, for example. So, so we are eNordic, and we have this arrangement with Ardian. So we sort of represent them here in the Nordic countries, and especially their infrastructure funds in the energy sector. So we do all things from deal origination to evaluation to negotiation structuring up to closing, but also the portfolio management side of the business, and working on a daily basis as sort of an extension of the deal teams of different Ardian infra funds.
Right.
So this is how it works. Ardian itself is the largest European asset management firm, if you count only like everything unlisted. So if you count like VC growth, buyout, real estate, infrastructure, that kind of things, not sort of listed equities, etc. So here in this space, in these asset classes, Ardian is the biggest in Europe with an AUM, assets under management of I think exceeding 160 billion today already.
All right. That's a pretty sizable,
that is quite a
player.
Significant amount of money. Yes. Out of that, more than 30 billion is in infrastructure funds, and here in the Nordic countries, we have currently an existing portfolio of more than 1 billion euro. So it's mostly 500 megawatts of wind power in 6 different projects in Finland, Sweden, and Norway, and then a larger district heating company. Plus, we are also now building our first battery energy storage project in Finland.
Okay, so is that actually sort of you nicely brought it to my next question, which is sort of like, what's a typical deal that eNordic does in the Nordics and the Baltics? Is that then wind? I mean, that's the existing portfolio. What are the opportunities that if you look at now the Nordic market and the Baltics, like what's
right? Yeah, in the Nordics, as we have all seen, especially Finland, Sweden, it's been very much a wind play in the recent years. So a lot of investments gone into wind power. As I mentioned, shows also in our portfolio. Right now, I think there is a lot of wind power under construction at the moment, but starting new is not that easy because there is just so much supply coming online and soon ready to build. So I think now it's time to wait for some more demand in this region, at least in these 2 countries. We are also looking into solar PV, which I think starts to be a business case also here in the north. And as I mentioned, we also we are actively actually not just investing in, but developing ourselves battery projects. So now that there's a lot of inertia going away from the power system because this sort of power plants are being replaced by wind power mostly. So there will be need for more like frequency control in the system, and the batteries are good solution to take care of much of that need to control the frequency to keep the grid stable. But broadly speaking, so we're glad to invest in anything in the energy transition, like assets, not necessarily like companies or technologies, but really like generation assets or storage or distribution, whatever type of assets, what can be called like energy infrastructure or structure like that. So that is, and I think we're going to talk about first of a kind, like new technologies, etc. So we also look at things like hydrogen, whatever, but obviously we are quite conservative in the sense that our kind of investors are not really up for technology risk, for example. So when it comes closer to, let's say, newer technologies which have like some novelty aspects, it gets a bit more complicated. But we are actively looking at different things.
Okay.
also that are not mainstream today.
That actually brings me two questions, which is first one to do more with the deal size. I mean, if we look at sort of like, wind parks and so forth, I mean, we easily talking about sort of, hundreds of millions, and so forth, right? But I mean, if you sort of going more to the energy storage side of things, hydrogen, the deal size tends to get a bit smaller. Is that correct, or is it that, or do you aim to sort of what's the range where when you're looking at a new deal, is there like a minimum size that it needs to fulfill, or what's the sweet spot,
Yeah,
so to say?
fully depends. As mentioned, so we work for more than one of Ardian's infrastructure funds, so they are quite different between themselves. So
Right.
one of them invests in the energy transition broadly, so wind, solar, things that I mentioned, could be hydrogen. Why not? The ticket size being sweet spot, if you ask, like 50 to 100 million. Could be as small as 20 million equity tickets, could be as big as 150 million equity ticket, or something in between. There are other funds. The latest Ardian Infrastructure Fund, number 6, it has a target size of 10 billion, and their ticket size is then obviously it's like a billion per
Right.
deal. So then
Right.
a different ball game in that sense.
Yes.
So it depends quite a lot. You said that are these new types of investments that are emerging, smaller in ticket size? Some are. Yes, there are, for example, distributed business models. We talk about electrification of heat and industry. So there, maybe you see smaller things that need to be somehow bundled. Also, batteries, as you said, those that are being built at the moment are rather small from an infra investor perspective. So we talk about, I don't know, 20 million, 30 at the maximum type of things. So quite small. On the other hand, maybe after a couple of years, because as I said, these are like a frequency control batteries, not real energy storage. These are not batteries which are primarily meant to trade in the power market. But when the volatility increases still a bit more in the market, then maybe there will be a business case for real kind of arbitrage batteries, and then those are the potential and need for those kind of batteries is much bigger. So then you could talk about, I don't know, 3-digit million batteries.
Okay.
Still not huge, but still like sizable, much more sizable
Deal
batteries,
size.
which are then easier for infra type of investors as well. But I think the market is not there yet. When you look at power to X, hydrogen, and that side of things, they're quite different in size. You see the smallest one being actually quite small, as I said, could be a few tens of millions, but then also many of them are quite huge. We talk easily about billion scale investments there. So just if an infra fund has appetite, there is opportunities for
larger
bigger
deals
sizes as well.
And that actually sort of brings me to my second question, which is, and you already mentioned it, the first of a kind or early of a kind, and that's really, if we go to power to X, different kinds of new storage solutions and so forth. The because if you look at the gap that really exists in the market, I mean, you have the VC funds, and then you have the project finance. Sorry about that. The large infra funds, but then sort of like, how do you actually make the leap? Say that you have sort of, promising technology. It has been, they've done the first of a kind deal, but if you look at the markets for these, say, in the storage or the hydrogen sector, that from the infra investor perspective, if you look at sort of the first of a kind, what needs to happen between the first of a kind and to the moment that somebody like eNordic could say, yep, this is the right moment that we come in? How does the market look to you?
Yeah, what needs to happen is that you need to make it an infra investment, which sort of ticks the boxes. And this is really one of my favorite topics. As I said, I've been looking at this business from many different perspectives, also as an investor and a financial advisor. And this really is, you could even call it a cliche, this like first of a kind thing when VCs go from from demonstration to something that needs to be delivered on a commercial basis, and that valley of death. But I always say that cliches are usually cliches because they are so true. So it's just a very simple thing that there is this financing gap, and European Commission, research centers, whoever, all have those research reports showing that there is a gap in the market here. And this is really a challenging spot, because that's where these different asset classes meet, very different mindsets meet, and very different type of money meets. And if you look at these bigger asset management firms, Ardian, but also any other who have all these private capital market asset classes, from VC to growth to buyout to real estate to infra. All these asset classes are often they are led, managed, operated quite separately and independently between themselves in this firm. So there is not much interaction naturally between these, also in the market. So it's quite often when you have when you are a VC which is developing something that is a solution that is rather big, we talk about tens of millions investments, capex per project, or even more. So still, it happens that the owners, the founders, the VCs might not have extremely much of experience in infrastructure finance or industrial finance in the end, and then when they need to sell those first cases to industrial investors or infra investors, whatever that solution is, it gets a bit difficult. So in short, VCs, they see the upside and the opportunities and the huge growth targets and numbers and etc. So infra investors are rather slightly closer to banks, for example, more interested in mitigating and sharing the risk and avoiding the downside rather than chasing the upside. And then sometimes you see VC entrepreneurs, for example, trying to convince infra investors with sort of wrong arguments, trying to sell a business case that the infra investor just can't invest in. So it's really,
can you give an example of
you need to make this puzzle work. So I think the main parties are really these two, but that there are also others. So quite often there is project development finance needed, and none of these investors very much like to finance project development. You quite often have industrial strategic investors, like industrial corporations, investing in these projects, which are also quite own type of animals, and more often than seldom you have actually government participating. If there are different support mechanisms or financing instruments or whatever provided by, or guarantees, whatever provided by governments, and quite often at this stage there are one or even more of these, and then making that puzzle work, that is really a big challenge, and one of the phases where I would say many of these companies with high capex innovation fail.
That is, I've made the same observation. The and it's as you said, it's a difficult nut to solve. I mean, there's so many parties, and would you say that? I mean, it's probably due to more than just one factor, but how much of that is that, if you look at in the VC level, the VCs themselves or the technology companies, how familiar are they with sort of project finance or infra investors sort of mindset and the requirements to begin with? Say that when they sort of enter into an investment into a technology firm, how many of them are actually sort of well aware of, they might sort of, I mean, they do realize that project finance is needed down the line, but out of, based on your experience, when you look at the VCs and the technology companies they have invested in, what sort of knowledge gaps or sort of misunderstandings arise in that? I mean, you mentioned that it's...
Yeah, I think that is a good question, and a lot of thoughts come into my mind when thinking about this. So yeah, there certainly is a gap, and I don't want to sound too critical, but on average, yes, I think many of these firms who will eventually face the challenge of raising infrastructure or industrial investment may not be sort of sufficiently prepared for that before they get there. And I quite often tell when I talk, I still talk to quite many startups, even if I'm in this job. So I quite often tell them to make sure that they have that knowledge early enough, because it's not only to get that knowledge when you get there, but it's part of your business plan from the beginning. So you need to have that equity story, the technology development story, which takes you there when you can have an investable project to be offered for an infra or industrial investor. So it means first you have R&D financing, then you need to make a pilot, then you probably need some sort of a closer to industrial scale demonstration, and then at some point you are ready to go and talk to sort of more mainstream infra commercial investors. And if you haven't sort of done the previous steps properly, so that you can show, for example, by evidence that we have tested this process, we have tested this chemical reaction, we have tested this and that, so it just doesn't work. So if you can show in a systematic way, like you did your homework before we came to you, Miss Infrastructure Investor, so then you may have just wasted years of time. So you need to take steps back to do your homework and then get back, because there are no shortcuts. It's not that infra investors would somehow, or other that kind of investors would apply different criteria. The structuring may be different, and then the required returns, whatever, can be different. But as such, the criteria need to be similar, and they need to be similarly solid projects, etc. And there is really this continuum, and it's also from financing perspective. You need to understand what kind of finance you need and what kind of finance you can have in different stages. And it really is that you need to start already your first of a kind project when you start your firm, basically.
Yeah.
So that is really one thing. Okay, there are other things that I would want to add, but maybe you want to chip in the middle.
No, I think it's interesting what you mentioned about the strategic investors, that oftentimes you see them involved, or at least, if I understood right, in sort of a good quality cases, you actually have strategic investors. Or is there what is the aspect that the strategic investor brings in this sort of a, say, early of a kind, first of a kind case that you as an infra investor sort of value?
Yeah, I think they really are a key in this phase. So they can bring so much. So if you want to make a bankable project, so quite often it, for example, means if that whatever installations is meant to produce something to some market, so you need an offtake contract. Someone needs to buy your product, and if you don't have those offtake agreements from your future first of a kind plant, it's difficult for anyone to invest in it. So if you can bring in a strategic investor from that industry, let's say you are producing green ammonia, and if you can bring in, let's say, fertilizer producer who is willing to put 10 million, 20 million in equity in the capex, it's nice. But what really can be value adding is if they give you a 10 or 15 years fixed price offtake contract for your green ammonia at attractive enough price. So just as an example, or when you look at the H2 Green Steel project in Sweden, which is a really well structured thing, it's really professional. That's a good case example, by the way, of how to develop a kind of a new first of a kind type of a thing. So they also understand how important it is to have like offtake contracts with solid, creditworthy off-takers. So then, these are things that industrials can bring in. They can bring in market understanding, how the market works. They can bring in technological knowledge and, so many things. Plus, what is good with them is that they can be a bit slightly more long-term investors than some other types of investors, for example. So a lot there. Obviously, the downside or the other side of the coin is that they have their own strategic interests, which might not be fully aligned with the pure financial investors on board, who might, for example, want to take the company to list it at some point, or be free to sell it to whoever they want. Whereas the strategic investor might, of course, want to have some strategic control of the future of that company. So there are these kind of challenges always.
So it's sort of a balancing act
it's always about balancing in that sense. Yeah, but in any case, it's so much more than just money that they bring. That's why you quite often see them involved with these stage investments.
Yeah, and I think this is excellent that you brought up the importance of the offtake agreements and the and sort of, you know, the one could say sort of the quality off-takers, so to say.
Yeah,
The because the offtake agreement, because that can be, there can be also linked to sort of like government or public sector side of support, or whether it's some sort of a incentive program or guarantees. And even if you look at sort of like the IRA program in the US, and or the Inflation Reduction Act thing. So do you actually see that if you look at a successful case from infra investor perspective, where they have ticked the boxes and they have the offtake agreement in place with good quality strategic players, do you see like government involvement in this, or EU money, or sort of something, or is this sort of pure market forces?
Yeah, it definitely helps. So, as said, quite often governments are involved in a way or another. So it could be just investment subsidy, for example, making it cheaper. So then you can just deal with the market player, between the market players. So then you can find an attractive price level for both the seller and the buyer if you have the subsidy in your project. But then, for example, what you see happening in the EU at the moment, so this, for example, contracts for difference mechanism is quite typical. It's very much in vogue at the moment. So European Union and individual member countries seem to favor it in quite many cases, whether it's wind power, offshore wind power, or whatever, but also using it in hydrogen market, for example, that you have a project, you have an off-taker, you place a bid to EU or to a member state that I will implement this project if I get €2 per kilo on top of my off-take price. So then that subsidy will cover, it will be sort of a top up.
It's like the cream on top.
Yeah, to the off-take agreement. So that's, and then that can be a competitive process. So those who need the lowest premium, they will get that subsidy, that contract for difference subsidy, and then that will help with the bankability of the project. That's kind of a revenue-based subsidy instead of capex-based subsidy. But public money can come in so many ways. So these are just, let's say, two very typical ways. And there are other ways, or so many other ways. For example, if you buy technology from somewhere else, another country, so it's technology export from that country. So then you can, for example, utilize export credit agencies of that exporting country of that technology, the home country of that technology company. So there are so many different ways you can utilize public financing or public subsidies in these cases.
Okay, very good. Well, as to wrap up, say that if we have here a technology company listening in, energy transition technology company, they are thinking, are we ticking up the boxes, and how do we prepare to tick those boxes? What would be your advice for a company that's not quite there yet with first of a kind, but is soon getting there? How should they prepare? What should they pay attention to, and what should they basically start working with starting yesterday?
Yeah, of course, as already alluded to earlier. So, I mean, again, another cliche, but team is important. So if you have that kind of an innovation, which is a huge industrial complex or an infrastructure asset, it probably means that you need a broad set of skills, not only technical, of course, technology, that kind of things are key, but you also need to understand, as I said, finance already project finance from day one to some extent to understand like what are you developing actually in terms of financing needs. You need legal, regulatory, marketing, etc. already from very early steps of the business, and that's obviously the first thing. Then, as said, be planned. So it's not just that let's think about it when we get there, but already know what are the intermediate steps before we are there, as said, so that you don't need to take steps back, which happens unfortunately quite often, I think. What else? Yeah, another thing, think about specifically thinking about a company arriving at this step of first of a kind or scale up. So think about how to convince that there is a pipeline, the scalability, replicability, modularity, whatever is your plan, but it's not a one of a kind investment. It has to be first of a kind.
First of a kind of a many of a kind.
Will not, an investor will not walk the extra mile just for that one first of a kind investment. They will want to see a pipeline probably, and you need to show that after project 1, 2, 3, 4, at least the fifth at the very latest will be more or less like commercially profitable. How to scale, but also how to make it commercially attractive without subsidies at some point if it's not in the first of a kind stage. So that is also really important. Think about agreements a lot. As said, offtake agreements is one of the most important things. But of course, all the EPC, like the project delivery agreement, O&M, all the performance guarantee things, etc., which are really key to these kind of investors to make sure that we are not taking technology risk, we're not taking regulatory risk, we're not taking market risk, we're not taking capex like a cost overrun risk. How to structure everything, how to mitigate risk, how to share risk in an efficient way between different players. And if you don't have all those pieces of puzzle in place, think where you can get those, because as I said, there are no shortcuts. So you have to structure it in a way that it is suitable for that investor that you're looking for. Quite often, also, as I said earlier, people try to explain things, but they just, if it's not arranged, explanations don't help.
It doesn't exist.
It has to be fixed. Or if it's not, then it's not, and then it needs to be fixed. It's not that it's not fixed and you just explain it away. That's not how it works. So you just need to be sort of humble and understand that there are no shortcuts.
Yeah, and I guess to sort of conclude, if you look at sort of like the technology company development process, it could actually be that, to reach sort of the infrastructure, sort of bankability, fundability level, that actually can be almost a longer path than say that what's gone through the VC technology, sort of like the VC funding round. So however, the technology has been developed and funded to that first of a kind moment. So that can actually be rather long path to get to that sort of a scale that somebody like eNordic or somebody else says that, okay, now it's the right stage for us. Is this the right reading?
Yeah, I think it is. And I would just like to add actually something. As I said, if it can be a very like plain vanilla structure, good, and that should be the target. But I understand that quite often, in many cases, it can't. So there needs to be some unique features. And one example how you can try and make these different worlds meet is you have that asset to be financed. So if it doesn't work exactly like that an industrial investor puts their money into that that project company and gets cash flow from that project directly. So then, for example, you can think of combining an investment in the tech company with the IPR and growth trajectories and like valuation upside, etc. And then, part of that money can flow via that technology company into the project, whereas bulk of it flows directly from the investor to the project.
Right.
So then the investor can get sort of an equity kicker, kind of an upside potential also from the tech company, or it can be a warrant or an option that the investor gets of the tech company holding the IPR, then to build some upside potential. Of course, doesn't work for mainstream infra investors, but could work for some other investors who would otherwise be capable, interested, and able to invest.
Right.
So you can also tweak, and I've seen a few cases where this has happened, that you try to do it like this.
Right.
If it's a very small investment compared to the sort of pre-money value of the company, if it's a 50 million pre-money value company and you have a 10 million capex for your first of a kind, then I mean you can just raise 10 or 20 million into that company itself. That maybe that's fine. But if the capex of your first of a kind project is 100 million, it gets a bit more difficult to raise if your pre-money is 50, or then at least the post value must be quite a lot. So then you start thinking whether there could be ways to structure in different ways. So I'm also saying that even if plain vanilla is the best, sometimes it's not possible, and then there can be ways around. But in principle, these type of investors don't like the term innovative too much, so it would be rather
that's more on the VC
like
side of
mainstream
things.
boring investment.
That's more the VC side of things, and not
exactly
on the infra project finance side of things. Super. Hey, thank you, Aleksi. I think this brought up important points and sort of definitely sort of things to think about for energy transition technology firms that are getting ready for market deployment of their technologies. So thank you, Aleksi, and best of luck in the Nordic Baltic infra investment sector going forward.
Thank you so much. Thanks for having me, and let's stay in touch.
Yep, thanks.
Good. Bye.
Thank you for listening. To follow future episodes, subscribe to our newsletter at www.actionenergymarket.com and select Action Energy Market Global Service. We publish new episodes on Fridays. If you are a technology provider or developer in the energy or clean infrastructure area, add your solution to our solution bank.